mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name is Bryce, and as always, I'm joined by my equity mate, Ren. How are you going, bro?
I'm very good, Bryce. Beautiful day down here in Melbourne. What about you?
Stunning day up here in Sydney. Beach day. Summer's back.
Yeah, well, Melbourne doesn't have any beaches, although whenever I say that to people in Melbourne, they always arc up and they say that the bay is a beach.
Yeah, St Kilda, mate.
It's not. A beach has waves. It's a bay with sand. Let's be honest.
So this is our second shot at the Learn to Invest in 15 minutes or less. Very happy with how the last three went. I hope everyone listening has really got something out of it as well. We've had some great feedback, so we're going to continue, push on. And this episode, we're going to be looking at the correction that was in February. So let's start off with what is a correction. For those that are unaware, a correction is when the stock market, whatever the index you're looking at, drops by more than 10% and over a reasonably short period of time. So that's probably the most basic definition. Corrections happen quite regularly in history, that is.
Yeah, so corrections are a term for not just stocks, but for anything. So, if the bond market falls 10% or, gold falls 10%, that's a correction in the price of whatever that asset is. So you'll hear it used a lot. A lot of people will just use it as a term, but it does actually have a technical meaning, and that's what you were talking about with the 10%. So
yeah,
technically, for something to be a correction, it needs to drop 10%. It's, similar to being in a recession. You actually have to have, now this could be wrong, but 2 quarters of negative GDP growth. That's technically a recession, but sometimes the term is used a little bit looser than that.
Yeah.
So that's the main thing to keep in mind. As you said, corrections happen. It's the nature of the beast, where all imperfect people trying to perfectly price assets, we get too exuberant and we overprice them, and then we realize that we were wrong and price is correct. It is literally the nature of market.
Since 1980, we've had 36 corrections on the S&P 500. So what's that? 1980, 2018, we're looking at 38 years, and we've had 36 corrections. And on average, they've been about 15% from the peak down to the bottom. And then obviously the thing to take out of that is the market's always recovered since. So I guess corrections offer opportunity, which we'll get into a bit later. But that's a definition, a basic definition. And to give you an idea of how often they occur, as we said, one happened in February 2018, led by the S&P 500 and Dow Jones particularly, sorry.
For our new listeners, the S&P 500 is the 500 biggest publicly traded companies in America, and the Dow Jones is a basket of 30 of the largest companies in America. So when you say that, you basically mean that America was the first country to have a correction.
Yes.
Yeah?
Yes.
Yeah.
And that led the ASX into a correction because we're a pretty reactionary market to what happened in the United States.
It led most of the world into a correction. It was sort of a rolling correction as different markets opened after the US market. So, it was America, then it was, now you're going to test me on which way time zones go. It was either Europe next, then Asia, then us, or America, then us, then Asia, then Europe. But yeah, it was a week of a global correction, really.
Yeah. It sent shockwaves because leading up to this point, the market had been relatively calm, one would say. We'll quickly look at volatility a bit later, but just back to the correction that occurred. So it started on the Thursday in the United States, carried through to Friday, but then the biggest day was when they reopened on Monday. Obviously, everyone had some time to think about it over the weekend and decided that it was time to move some money around. So the stock market in the United States, the Dow Jones Industrial, had the biggest points fall it has ever had in history. So 1,175 points it fell, which is just an indexing system. So the Dow closed on that day down 4.6%, which actually put it into negative territory for the whole year. And overall, over the 3 or 4 days that it was dropping, it went down just over 10%. So that's why it was officially declared a correction. The previous largest drop on the Dow Dow was 778 points, so quite significant, and that was back in 2018. Keeping in mind that in a percentage terms, it's not the biggest drop in history, but in a points terms, it was because the Dow was so high.
Yeah, so that's a really misleading stat. That got rolled out in all the headlines, but just by nature of an indexing system. So as the later we go and the more the market grows, the points drops will always be higher.
Yeah.
So as an investor at home, or really as anyone interested in the markets, what's more important is the percentage terms rather than the actual points term.
So that happened. So then it raised a number of questions to why did it happen? You know, there'd been a lot of chat for a while about the market's going to crash and all that jazz. And obviously this is not a crash. It was a correction at the time, but it definitely got a lot of people.
A lot of chat, mate. A lot of chat from you.
Still waiting.
Yeah.
Let's look at why it happened. And there are a number of reasons why it could have happened. And you can't really pinpoint one reason why. But one of the reasons that has been discussed is that, you know, the market focused on the threat of higher inflation after jobs reports showed a pickup in wages in the United States. And that was released on the Friday, I'm pretty sure. And so when those figures came out to the market, increase in wages would lead to an increase in inflation, which is increasing everyday goods and services, the price of everyday goods and services. And when you get inflation, it's likely that your reserve bank is going to increase its interest rates. And the market is so used to having such low interest rates at the moment that they perceive an increase in interest rates to be a bit harmful. Do you have anything to add to that, Ren?
No, I think that was pretty comprehensive. So it's just a chain reaction that you need to conceptualize. Wage growth, yeah, as you said, leads to inflation. Inflation, the Reserve Bank tries, or the Federal Reserve over there tries to manage, so they increase interest rates, which makes borrowing money more expensive, and makes existing debt more expensive to pay back.
Yeah.
And that's meant to put a dampener on the spending in the economy, which will control inflation. But for businesses who have debt or who need to take out debt, it's going to be more expensive to service, which will hurt their profitability, and the share market then prices that in, and that was one of the reasons given why the market started to slip a bit on that Friday.
Did you have any other reasons that you came across?
Yeah, I don't know how true this is, but one that a lot of people spoke about was that the reason that the market fall turned into a correction was the influence of algorithmic traders. So essentially what happened was now this is going to be a little bit technical, but a lot of big investors and funds had purchased a financial product called XIV, which was bet on volatility, so the amount of price fluctuations in the market remaining low. So they were betting against a volatile market, America.
And doing pretty well over time.
Yeah, smashed it.
Make a lot of money.
You can look up the chart for XIV on Google, and it is literally almost like a diagonal line up.
45-degree line.
Yeah. And then it just crashes down to near zero. Now, the reason it crashed down was the market all of a sudden became volatile again. Some people believe it was sparked by this jobs report. I mean, it's all a bit uncertain, but what then happened was the algorithms to cover their short volatility trade automatically bought short options in the market, and then that exacerbated the downturn. So, I mean, look, I don't know. I'm not an algorithmic trader. I'm not sure how much truth there is to any of that really, but that is a theory that's out there about how this jobs report led to a correction.
Yeah, it's an interesting topic, the algorithmic trading, and it often leads to, in these sorts of environments, really sharp movements in price because their algorithms obviously react so quickly. And if you have a look at the Dow Jones chart over those 4 days that the correction came, you'll see that it drops significantly, and then almost within a minute, it's just almost back up to where it was. And you can probably attribute that to a lot of algorithms kicking in when prices hit their low point and they buy, and then it all comes back up. So
look, I think the understanding why it happened is probably the least important part of this episode. I think if you understand what a correction is in a general sense, and then what specifically happened in February, understanding why it happened happened is never going to be as important as the next part of this discussion,
Yes.
which is what do you do when
do.
something like this happens? Because as you started this whole conversation with, in the last 38 years, there's been 36 corrections.
Yeah.
It's going to happen again, and likely, sooner rather than later. So don't worry too much about why it happens each time, because each time it will happen for a different reason. There might be, it could be wage data, it could be a housing price shock, it could be an oil embargo, it could be a war, it could be, climate change gets exponentially worse. Like the reasons are literally infinite, well, almost infinite. So to worry about and to understand why each specific previous instance has happened isn't as important as knowing what to do when one does happen again. So in that vein, what should you do?
Well, that's a very loaded question.
Yeah.
I guess for me, there's two parts to it. It's what do you do in the moment, and then also what do you do to prepare yourself for the next one? So how do you either protect yourself, or in my situation, I obviously believe something's bigger is coming, and so I want to have cash ready to take advantage of what they call buying the dip, which is where a lot of investors get in when this correction comes at 10% and they start buying up because obviously stocks are somewhat cheaper than they were prior, and this drives the market higher. But what did you do, Ren?
So I think there's two things to it, and I'm mindful that we're brushing up on 15 minutes, so this will be quick.
Cool. Yep.
If you already have stocks in the market, like if you're already in the market, don't panic sell.
No.
Rule number
the worst
one.
thing you can do.
Yeah, if the market has fallen and you're holding, just wait it out.
Yeah.
Second thing, if you have cash on the side, the correction is always a good opportunity to get in. So I know, as you said, you think there's going to be a bigger correction, so you are waiting, and that's fine, but there's no harm in putting some of the cash into the market, because what we've seen since the February correction is that the market is basically back up to its previous high.
Yeah.
So in a month, or in a month, the market has basically recovered 10%. So if you had bought at the bottom of that correction, you would have made 10% of your money. So
that's probably the main two things. Definitely don't panic sell. That's the worst thing you can do. You'll definitely sell at not a loss. You may still be in profit, but it's happened 36 times over the last 38 years, and we have had record highs. So if you had sold, then you would have missed out on these record highs. So I guess that's the main takeaway is don't panic sell, wait for it, and if anything, buy more of the stocks that you were in if you have the ability to do so and you still think they're a good company that you'd want to be in.
100%. Now, speaking of panicking, we are brushing up on 15 minutes. So
Okay.
I think that does it if we're sticking to our hard close at 15 minutes.
Yes.
Thanks for listening, everyone, and we'll see you in a couple of days.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.